Hello, everyone. Hope all of you guys are enjoying your day, your week, your month, your year. Um, very excited to have you guys in this academy. As always, I'm very appreciative of everyone. I know this trading, doing those things isn't the easiest thing to get into, but when you guys get it down, it's very profitable. And you guys will thank yourself in a matter of 2 to 3 to 4 to 5 years because of the type of income that you'll make. And remember, it's the consistency behind this that's what it's going to make you truly great in this. So it just takes time getting this down. Once you get it down, you will be very profitable. You'll be very lucrative. Your accounts will grow, and you will be able to pretty much go and do whatever you want in life. And that's really kind of what it's centered around: is what do you want to accomplish with trading? Where do you want to go? Where do you want it to take you? So what I'm going to do now is we're going to break down Fibonacci. So what I'm going to show you guys is I'm going to let you guys kind of see what we're doing and why we do the things that we do within Fibonacci. So just to use some examples really fast, Fibonacci, what it is it's a mathematical breakdown of basically where the chart will reverse at and where we could potentially see it going. Okay. So what I learned in this is I kind of seen the tool first. It was really complex. You know, I was like, what is in the world is this thing, right? I was like, what in the world is this thing? And just to do something for you guys real fast, I'm going to add something here. I forgot to take those off. But yeah, so I was like, what in the world is this thing right here? Like, I had no idea what this was. And this is basically the Fibonacci tool. It's like, how do we use it? What is it used for? And all those kind of things. So you can only use Fibonacci, okay, just so you guys know. You can only use Fibonacci in a trending market. So it's what I call excitable moves. You know how I tell you guys about the excitable moves, and I talk about all those things. That's what I'm talking about. So you can only use this tool in excitable moves. Now, the two things that you guys just got done learning, which was the three-line system, the heartline system, and then the confirmation zones. When you guys look at Fibonacci, this is kind of like beyond that and also inside of that. So when we finish this, I'll show you guys what I mean inside of that. But it's kind of, it's what is really beyond this, so that we can figure out what's actually happening and why the things are actually happening with the times that they're happening. So give me 1 second, one moment. Okay, cool. That was I'm actually on a resort right now doing this video for you guys. It's a part of one of my morning routines. And that was some people coming in, making sure I was okay because all the lights are out. So that was funny. But anyway, so with the tool, so how this works, and sorry about that again, but with the tool and how this works is it can only be done through trending markets. So whenever we're doing everything, we just have to make sure that how things are going is it has to be done through a trending market. Now, when we look at this, so I'm going to show you what this looks like. Okay. So when we have this, how it actually starts is it starts always with an excitable move. That's what it starts with. It always starts with an excitable move. Okay. So we have our area here. Now this is what it looks like. So there's going to be a dynamic that happens at the top of this here is we're going to get like some type of candle. So let me fix this really fast so you guys can see what this looks like. Okay. So we might have something that we might have a candle that looks like that, right? Then what will happen is we're going to have like that movement that happens, okay? Now what's going to happen at the very bottom is we're actually going to get candlesticks that come down here. Now what I mean by that is we're going to get a specific candle, bullish or bear, and it's going to hit right at the bottom of the excitable move. Now what's going to happen next is we're going to get a bull. Now, so this is a bearish excitable move. Remember this. So stick with me. This is a bearish excitable move. It just happened. Then we're going to get a bullish candle that's going to hit right here. As soon as we get a bull and a bear happen like this, what we're going to do is we're going to then fib it from the wick. So let me actually fix this really fast because it's a little harder to see this. So we're going to find this, okay? We're going to find this, and what we're going to do is we're going to fib it. Now, the way that I pull the fibs, okay, this is how I pull the fibs. I pull them right to left. So I would pull this one from right to left like that. And it's always from wick to wick. So I'll move this down a little bit so it matches with that area. And you have to make sure that you get it right from wick to wick, okay? So that's how this is going to go, wick to wick, right to left. Now, when we're doing this, so in a downtrend, so this is how you would write this down so you guys know. In a downtrend, you're going to pull this from bottom to top, which that is right to left. In an uptrend, you are going to pull it from top to bottom, which is right to left. And the numbers in this that you're looking for are 3 core numbers. It's 3 different core numbers, okay? So you're looking for 3 different ones. It's these 3 right here, okay? These are your main Fibonacci entry points. That's what these are. So these levels that you see, that you guys look at right here, these 3 numbers, the 61, the 50, and the 38.2, those are your entry points, okay? So those are what you look for an entry because they're the 3 major reversal points in this market, all right? So, and if you do this now, this is where things get very fun for us because now we can start seeing levels of entry and we can start seeing stop loss levels. Now, this is how this works. So this is how I'm showing you how you will always be profitable in doing this if you just stay consistent and follow the strategy. So you have your confirmation buy and sell zones. You have your confirmation you have your heartline system as well. Now what this is it gives you a continuation to follow, okay? So you have your 61.8, your 50, and your 38.2. These 3 levels right here. These are the main 3 levels that you look for. Your 61.8 here and the 78.6, these 2 levels are what you call shallow retracements, meaning that if your market goes here, reverses, hits it here, it's usually a shallow retracement, okay? Here is also a shallow retracement because it doesn't retrace the whole entire way, so it's like a small retracement. It's what we call shallow retracement. I'm going to explain what this number, and this number means as well here in a second. When you go to the 50, it's kind of like whenever you go shopping and you go, you went a month ago and you see these shoes that you're like, oh dang, they're $100, and I don't really have that much, or I don't really want to spend that much on that. And all of a sudden you go back a month later and you see that they're 50% off. You just look at the market like, okay, let me go ahead and snag this real quick because of the psychological standpoint behind it. And this 38.2 level, when we look at this is where banks enter. Banks, institutions, universities, this is where they enter. So they usually like to see a little bit more of a retracement, then they come in and they invest their money. So it's based off those algorithmic systems and things like that. But a lot of times the market reverses here and it reverses here. What you're going to do though is pair them with previous support and resistance levels. So you have to keep that in mind. Previous support and resistance levels are going to be very, very key in understanding and doing the strategy. Now, when you enter off of these positions, if you enter off of the 61.8, guess where your stop loss goes? Directly above your 50. So you have to look at like a 25 pip stop loss if you're trading on like if you're trading on a bigger time frame, you kind of have to judge it. I will just tell you, I can't give you the exact pip count because I don't want to limit you to anything. So I want you to kind of know that it's not about a specific stop loss like level. It's kind of like you want to put it a little bit above the 50. You don't want to put it below it if you're entering at the 61.8 because it could go up to the 50 and then reverse. See what I mean? So you want to put your stop like somewhere like right in here, all right? Not too far to the 38 and not too far, not too close to the 50. So you wouldn't put it right there because it could reverse. And you wouldn't want to put it about right here because it could just wick it and reverse. So you want to put it a little bit about right there. If you enter in the 50, so if you come in here, where do you think you're going to put your stop? The 38.2, a little bit below that. If you enter in at the 38.2, where do you think you'll put your stop? 23.6. Because usually what happens, guys, is when it hits a fib level, it's going to reverse, or it's going to trade from fib, so 61.8 to 50, and fib to fib. That's how they trade. That's how the market works, okay? So we want to make sure we protect ourselves, all right? So we place our stops there. Now, where do you think we put our take profits? Our take profits are actually, which is really cool, is these three levels right here. This is where our take profits go, are these three different levels down here. Now, you don't always have to put them at these specific exact three different levels, but these are where our take profits go. So check this out. If you're entering at the 61.8 and you put your stop right at the 50, a little bit above the 50. Now, this is the weekly chart on GBP USD, so this is going to be like a, a pretty big, it's going to look like a big stop loss. So 330 pips, okay? Look at what your reward is. 1,400 pips on the first one already, 1,400 pips. So that's over, or almost, what is that, 4-to-1 trade, 3, 6, 9, 12. Yeah, so that's over a 4-to-1 trade. This one, look at the risk to reward on that, and then look at the risk to reward on this. Now, I'm not saying that they're going to go to those places. I'm just giving you an ideal point, because here's what these levels mean down here and why I say this. These are also exit points in the market. So you have your banks, your institutions, your universities exiting here, and exiting here. You have them exiting at those levels. There's the 261.8 and the 423. They exited those as well. But these are like my three favorite because of what they signify. They all signify the same thing, but they're when you get into the next part of my strategy, I'm going to show you what I mean by this. So when you enter at those levels, that's what this means. So if you're like at the 50, you enter in at that 50 mark, then you come in here at the 50. So your stop is going to go a little bit above your 38 level, okay? And you enter in at this 50 point right there as soon as it touches. That's a 333 pip stop. Your first one is even bigger now. See that? So it's like 1,600, it's almost 1,700 pips, really close to 1,700. Second take profit is basically 2,500 pips. And if you go down there for 3 entries, then it goes even further. So what this is, guys, is this is you maybe losing a couple of trades. And then if you win one trade, if you get one of your trades at your take profit, guess what you do? You make up everything and even more. So what you're doing, your risk is very low on your account. So here's the thing. So this might be a question you guys want to know. So if I'm entering in at the 61.8, my stop is at the 50, and I'm only trying to risk 2% of my account or 5% of my account, what you're doing is if your stop loss gets bigger, guess what happens to your lot size? It gets smaller. So you can't trade with the same lot size. All right. So if you look at this account that I have pulled up right here, so there's an equity of $570.20 in there. Okay. So if you look at that, when we take this trade, so to trade on this and to trade with proper risk management, and you trade with 0.05, okay, that would be trading with proper risk management on this account, no bigger than 0.05. It doesn't mean on every pair you trade 0.05 because that would not be proper risk management. But say you traded with 0.01, okay? So if you were entering right here at the 50, okay, and then you came up here with a stop loss of, let's just say 350 pips, okay? So that would be $35. That would be $35. So percentage-wise, would you be risking less than 5% on this account? Yes, you would be risking less than 5%. And then what would be your maximum reward on this trade? You're looking at, let's just say 1,700. So you're looking at $171. Is that over a 10% reward? Yes. So you're risking less than 5% to be able to gain over a 15% ROI. Do you see how that works? So do you see why I say you can have longevity? That should bring a smile to your face. You should be happy because this minimizes it so much. It makes it so less complicated. Trading, I'm telling you guys, is really simple. We just use words and meanings to make this hard. And we listen to all these other people that trading is hard in this and trading is hard. It's a little challenging, don't get me wrong. And for me, it was very challenging because I didn't have proper guidance. You guys have proper guidance, okay? So do you see how I just used that little example? That's how it works. So guess what? If you guys are trading on a smaller time frame, so let's just go to odd USD. Let's shrink this down, okay? Shrink this down. So let's shrink this down. Do that same exact thing that I just did, okay? So let's just do that same exact thing that I just did. Fib that, excitable move to the downside here, okay? Get it right there, all right? Let's put our stop loss above this 50, okay? Right about there. Do not need to do that. And we take our entry here, okay? So this is how it switches, okay? So now we're risking 17 pips, okay? And now what is our gain? 63. Every single, this is why I said this strategy works on any time frame. Everything I'm teaching you, any time frame. It does not matter how you guys do this, okay? 17 pips for 63 pips. 17 pips for basically 100 pips, okay? What is your risk there? Trading on that, you're risking, what is that? You're risking $1.07. I think that's how that is. It's not, yeah, it's $1. And so let's just basically say $1.70, okay? In order to gain $6.40, in order to gain almost $10, and your account increases. Okay, so what is it? What are you looking at? You're not even risking 2% on your account. You're not even risking 1% on your account when you're looking at something like that. But you're gaining. What are you gaining whenever you look at that? So that's why I'm saying that this strategy, it doesn't matter what you trade this on. It does not matter how whatever you do it on. Just know that whenever, if you kept that same exact what I just said, now you can, instead of trading 0.01, what can you trade? You can trade 0.10 because now you're risking $16, okay? So you're risking $16. Is that risking more than 5%? No, that's not. To be able to gain $63. So what is your reward on that? To be able to gain $100. So what is your reward on that? So do you see how that works? You just switch your lot size. That's it. You switch it. But you just make sure that you don't risk more than 5%. These trades will pan out for you because you guys know how to trade. If it's going to go your way, guys, it's going to go your way. If it doesn't, it doesn't. That's just plain and simple. If it doesn't, it doesn't. So let's look at some levels here on your chart that we can look at and we can see how this would look to go. Okay, so let's auto adjust this really fast and let's look at this. So let's just find some things. Let's look at this because this is a very easy trending market here. So we have an excitable move here on this weekly chart. Let me pull this away a little bit. So we have an excitable move on this weekly chart right here. We see the downtrend, right? And you notice, you see how this pulls up right here? This is an area of where you can pull the fib. But do you see how the candlesticks are bigger right here, the bulls? And you see how there's more of a retracement? This would be where you would pull your wick to wick from, okay? So say we were to take entry off of the 61.8, okay? We enter off of the 61.8. Our take profit is the 127. Do you see how this immediately hits this and it reverses? It's no surprise, okay? Do you see how the market hits this 161.8 and immediately reverses? Do you see how this 200 gets hit and it immediately reverses? What I want you guys to understand is you're like a ninja right now in the market. That's what you're like. You're like in this market right now. You're like a sniper. So you're in here strategically entering in the market like crazy, okay? So you're coming in and you enter off of this 61.8. What I want you guys to do is be 1,335,000% calm whenever this trade goes negative. You do not have to worry about this. If you are risking less than 5%, you have nothing to worry about. And you are following these rules, literally, you don't. Because you already know, okay, I'm risking 5%. My stop loss is right here on this level. You're coming in and you're saying, cool, boom, I entered in. You know your stop loss is 463 pips. So you know you're not going to risk. And I'm not saying you're trading on a $570 account. You can be trading on 1,000. You could be trading on 200. You could be trading on 10,000, 100,000, whatever. It doesn't matter. You just know. There's also an app that you guys can use, a risk management app that you can put your account balance in, put your risk, what you want, put your reward in. It's going to do everything for you. If you guys want that, message me after you see this video because I don't know the exact name of it right now, and I'll be able to know when I'm done. I don't want to interrupt myself. So when it comes here, you know that's what you're risking. But guess what you know your reward is? You know your reward is 1,700 pips. You know that. You know you're looking at already a 2-to-1 risk to reward, 3-to-1 risk to reward, 4-to-1, 5-to-1, 6-to-1. You're already looking at that. You know that. So when it comes here, there's no reason to worry. So when it comes up there and it comes down, look what it does. So you enter here, and then it goes up in the next couple months or couple weeks. It goes up negative 330 pips. But guess what? We know what our risk is already. We're not blindly entering a trade like heathens. We're just getting in smart. And then it goes down in a matter of 14 weeks, 13 weeks, and we're positive 400 pips. And we might, of course, we might be happy and excited, but if we follow these rules, guys, it's going to go your way, okay? They're going to go your way. And even if they don't, guess what? You lose a trade, you can find another setup. There's always going to be setups. $6 trillion market, okay? So it comes down, and it goes down 1,000 pips. And then finally, on 38 weeks later, we get our 1,700 pip take profit hit. And we just increased our account by 20%, by 10%, by 15%. And we keep that trading process up. And say we had 2 trades in, then we just increase it even more. So you see how that works? Now imagine you guys got in at the 50 level, okay? You got in right here with a stop loss at the 38.2. You guys got in, boom, got a fleet tree. The trade is going your way. Beautiful. What these levels are your take profits, and you guys see how the market reverses at those levels? It's going to do that almost every single time. Sometimes it will respect them, sometimes it won't. This is another one here. This is a pretty easy one to see right there. So if you're to pull this wick to wick here, you can see that there. This one would not hit your 61 level. Sometimes it does that. So there's no reason to trip out if it doesn't. But do you guys see how it still reverses the 127? Those things usually happen almost always. This level here, so we can see this. So you guys we can zoom in on this a little bit. Zoom in on it. Let's bring it over here. shift this over. So say you guys got in at that 61.8 level. Do you see how it gets in here and it trades down? And remember when I said it trades fib to fib? So it hits it here and it goes down 227 pips. But you know your stop is a little bit above that 50. You know what your risk to reward is. But do you guys notice how it actually doesn't go and extend to your 127? Oh my gosh, what do we do? So when your trade goes a specific amount in profit, okay, you have to learn how to pay yourself. So either you can tell yourself, I'm going to put 2 to 3 trades in every time. And on one of my trades, I'm going to take a 78.6 level, and I'm going to take that. I'm going to pay myself. On my other 2, I'm going to keep those trades. But if it reverses and it formulates a what? Confirmation zone, consolidation zone, I'm going to take my trade out if it breaks back above the 78. There's a lot of different things that you guys can do that you can play with whenever you're trading. So I can't give you the exact and say like, hey, you got to keep it in at the 127.2. You don't have to, but it might go there. It's not always going to go to the 127, always going to go to the 161. I don't want you to think that just because you use this strategy that it's always going to go there, but it has a very high probability chance that it will go there. Because you got to remember, people are buying and selling all the time. So it's whoever is really stronger. Okay. But this strategy is going to show you guys how to catch pips. So yeah, you guys, you'll play with it and figure out like, I feel good about if it reverses, if it comes up here and it formulates our box that we get down there, that if it comes up and closes back above another fib level, then instead of it coming back into my entry point, I'm going to put my stop in profit at 50 pips, 100 pips, or whatever that you guys have, or 10 pips if you're trading on a smaller time frame. And I'm going to go on to a no-risk trade, and I'm going to move on to my next market. And if it hits my stop loss and profit, it hits it, I still paid myself. So you guys got to make sure that you do that as well. We can see this excitable move here, and this is an actual real time happening. We get this, and we can kind of see our trade from this level here come down. So see, if you were to take that 50 perfectly, that thing would just have skyrocketed, and you would be elated. Even if you were to take the 61, that one went right up. So it's just about following with risk management, being patient, guys. There's a lot of different examples I could show you guys on all these different charts, but I think that one pretty much suffice because of the downtrend to uptrend quality. So on the next step of the strategy, you guys are going to see some really, really cool stuff happen here. I'm really excited, and on the final one, you guys are going to be like super Jedi ninja samurais up in the market. So it's going to be really, really cool. So I hope this video brought you guys a lot of value. And that you guys have a great night, a blessed weekend, amazing day, morning, and I'll see you guys in the next video.